anytime you have this kind of uncertainty, this is a time that active managers thrive, right? It's a time where we would encourage people to go more with quality assets, look at big balance sheets. It's a reminder, bear market's always a reminder that dividends are 40% of the total return of equity markets. Even on the fixed income side, that's where credit spreads widen. You pick your places, you pick your place on the duration curve. And so, again, I think it's just an opportunity for active management.
How are you thinking about asset allocation in this environment, Jenny? Because that 60-40 rule is being challenged, right? We're seeing more flows into the bond market, seeing more flows into fixed income assets, highest outflows in the last 12 weeks seen out of equities. How do you think about that?
So I think, when people say 60-40 is challenged, to me, I think what's happening is that we've gotten better with the tools that we have and the risk management tools to actually be more precise in the allocations based on a risk profile. So I think it's just more of an evolution. And I think times like this just remind us why diversification of a portfolio is so important and true asset allocation is really important.
And you think that right now, in this environment, active management is the place to be?
I think this environment is absolutely fertile ground for active management. I think where active management struggles is what we've had a decade of governments printing money, basically interest rates at zero, nowhere to go but throwing money into the equity markets. Everything was correlated and moved up. And now we're really seeing the real companies that have good business plans, good value, stable balance sheets. Those are outperforming some of these others. And so I think this is when you want to be doing in-depth research and deciding who can withstand what I think is going to be a choppy period.